Welcome to Hedge It Forward. We will look at our setups through a macro view lens of the economy. We'll build out our thesis before we dive into specific trades. With that, check this out. 101 subscribers. Thank you so much. I actually hit 100 on New Year's Eve, so thank you for that. And I had someone send in a picture. I am in the living room down in Texas. Thank you, Matt, for sending that in. Thank you so much. That means a lot. Check this out. I went ahead and modified my background. I was kind of getting tired of the old chalk, and those that know me know I'm an aviation buff. I'm a pilot, and so I decided to put some stuff on the wall that illustrates who I am. I've got some aviation related stuff, and I've got my favorite investment books, fixed income, some technical analysis. My all-time favorite options is A Strategic Investment by Lawrence McMillan. I highly recommend it. All right, let's jump in. Let's take a look at unemployment. This goes back to 2024, 2025, and where the growth has been and has not been. And take a look at this. Leisure and hospitality. This one was a big increase. Construction fell. Government fell back in October. We expected that because of the layoffs and when they reported. So pretty much flat for the last couple of months. Retail fell. This is a little bit surprising. We'll look at the details here in just a second. Transportation continues to fall and manufacturing continues to fall. Not to pick on Trump, but back here when he implemented the tariffs in April, he started making big moves, big claims back here that he's going to be bringing manufacturing back on shore. I don't see it yet. It has had several months of decline. I don't expect that to change unless there's something structural inside the U.S. economy. I just don't see, knowing that he's got 3 years left, are going to spend billions and billions of dollars to bring manufacturing back on shore when it's only 2 or 3 year problem. So I don't see manufacturing really going up a lot. And then temp worker continues to decline. Looking at the report itself, non-farm payrolls added 50,000 jobs. Really no change. Unemployment was 4.4. Slightly below. The forecast was 4.5, but really it changed a little in December. And this is probably by a decimal point or two. Healthcare, 21,000 jobs add. This is a continuation. This, whereas the aging population continues, we'll see this continue to rise. Social assistance also up 17,000. What I found interesting though was retail trade. Look at that, 25,000 jobs lost in December. A little surprising to me considering it's Christmas time. This is not typical. I don't know what to make of that. 19,000 jobs lost in general merchandise, warehouse clubs, 9,000 in food and beverage, and then 5,000 in electronics and appliance retailers. Again, 25,000 jobs lost in December in retail. Interesting. And then take a look at this. October was revised down by 68,000. 8,000 in November. So together, 76,000 less jobs than previously reported. Expect that this 50,000 jobs add this month will be revised down. There's some good news. Look at this. Employed. Number of employed people increased by 232,000. The number of unemployed month over month decreased by 278,000. So this is good. The civilian population or the civilian labor force fell by 46,000. Not much to see there. Check this out. We talked about manufacturing a minute ago having a decline. This is the diffusion index. Manufacturing at 38.2. Anything above 50 is growth. Anything below 50 is contractionary. And you are definitely seeing manufacturing continue to contract. You can see that in the reports. Going on down, less than a high school diploma. This is good news. Actually good news across the board. Less than a high school diploma increased by roughly 150,000. You would expect that, seasonal jobs. High school grads, no college. That was also an increase of about 500,000. Some college or associate's degree increased and bachelor's degree increased as well. So really good news here. Take a look at this one. Multiple job holders. I reported on this one last month. It was the highest ever at 9.3 million. We are now down to 8.8 million multiple job holders. It's still a lot when you look at this over time, but it's coming down, and that's good news. All right, my favorite part of the report. Where are the increases and where are the decreases by category? So total non-farm is the 50. And then it's broken up into private and government. There's government. And then within that, within the private sector, you've got goods producing and you've got services producing. So think of when you're looking at inflation and thinking about where the ads are, this is just a macro view of where employment is occurring. So within goods, look, goods down 21,000. This is good for inflation, right? Bad for the people that lost jobs. It's showing that there's less demand for goods. Construction down 11,000, manufacturing down 8, non-durable goods down 5. Under services side, we're up 58, so that's good news there. But there's that retail trade down 25,000, transportation down 6.6, Information, IT's flat. Financial activities, call that flat. It's only up 7,000. Professional and business services down 9. The one I like to keep an eye on is where's the hiring? Take a look at employment services, down 11. Temporary help, down 5.7. Private and education, this is the area that if we did not have growth in the aging population and we didn't have growth in the jobs part supporting the aging population, you would have had a big decline. So this is news for the bears. So private and education, health services, 41,000 ads there, 47,000 in leisure and hospitality, and then in government, 13,000 ads. Within federal, you had a +2, state government -7, and then local government +18. So all in, a little bit of news for both the bulls and the bears in this report. And that wraps it up for employment. All right, let's take a look at interest rates. The 10-year has stubbornly remained at around this 4.15 mark. And this is how mortgage rates are based. If you look at the mortgage rates, 6.16, about 200 basis points above the 10-year. This is the part of the curve that matters. It is not what the Fed does when they cut rates. Speaking of cutting rates, this is ZQZ26. This is the terminal rate. This is where the market thinks that when the Fed cuts rates, where that rate will be by the end of the year. The Fed thinks they only have one cut. We saw that on the FOMC projections in December. The market right now is pricing in 2 cuts, and I'm in the camp of 3 or more cuts. Look at this. Unemployment came out and immediately fell, meaning less than 2 cuts. So I added to my position here. I sold back here, but I definitely added here because I'm in this camp. Even if it's 2 cuts, I have nothing to lose because it'll just sit here. But if there's any kind of negative news and unemployment increasing ever so slightly, weakening wage growth, I do think you'll have a higher chance of cuts, especially when you get the new Fed chair that is going to be aligned with the Trump. Which, by the way, I don't know if you guys have seen this in the news, but Trump has bought $100 million in bonds. No wonder he wants rates to cut. He'll win big time on those $100 million worth of bonds. So will everybody who holds bonds. Take a look at where the market is pricing in rate cuts and when they will occur. These are the Fed meeting dates. 95% chance that it will stay no cut in January. So 4.4% chance of a rate cut. The market isn't pricing in a rate cut really until June. And then after that, September. This is where the 2 cuts lie. And what I'm playing is this December meeting here. So this is 2 cuts currently priced in. I think it's a little bit light. Another website I want to show you related to this mortgage rates is Mortgage News Daily, mortgagenewsdaily.com. You can go out here and they track the rate every single day. And there's the 30-year, the 15-year. So what I'm reporting is more on a weekly level. This, if you want to see it every day, this is where people go. 6.17 on the 30-year, 15-year is 5.71. But take a look at this. Donald Trump had but strongly suggested, I would imagine, to Fannie Mae and Freddie Mac to buy $200 million worth of mortgage bonds on Friday. And take a look at this. Is going to put pressure on mortgage rates. So we're now down to 6%. So 6.06% on interest rates. We will see if that continues to decline. I don't know. I think it will probably pop back up because that might have been a one-time $200 million invest their cash in mortgage bonds. But with the 10-year staying fixed where it's at, I don't see really mortgage rates falling a whole lot until the 10-year comes down. All right, so jumping into the market, let's take a look at where we're at. We're at all-time highs. We hit another record high this week. We closed at 69.66 on the S&P. Earnings for this week. I'm excited that earnings are kicking off because there's going to be a lot of opportunity with put sales, which we'll get into here in a little bit. But earnings, $312.83 per share. The market is 22 times earnings. We will see if this goes up. In fact, analysts are predicting an 8% year-over-year increase from last year on earnings. So if that happens, that'll bode well for equities. I had this 7,000 line drawn out here a couple of months ago. We did not quite make it by year end. We were 6 points off. We hit a high of 69.45 on December 26th. So we did not quite hit 7,000, 6 points away, right? It looks like we're really close now. We're only about 3 points away from hitting 7,000. Now we do have some support and resistance lines I have drawn out here. If you do get a pullback and you're below the 6,800, that's going to be a negative, and you could probably retrace all the way back down to the 6,500 mark if you close below this. But where do we go from here? We have no resistance. There's a couple of ways we can calculate it. One is take a look at VIX. Look at the implied volatility for VIX, and you can calculate mathematically where that will end up, which is in 30 days, the 7,200 mark. So that puts us up to about right here. That'll be the next target zone. Another way you can look at that is take a look at Fibonacci. So Fibonacci is someone who identified patterns and ratios within the universe. Take a look at designs. They all have a golden ratio. It's phi on the Greek alphabet. Take a look at the Parthenon. It is designed with the golden ratio in mind. Our eyes, our hands, they're all built within the golden ratio. If you look at furniture, houses, all of that all has the golden ratio. There's a theory that golden ratio also exists in economics and within the market. Let me show you this. The market moves from level to level. And when you look at Fibonacci, you go from the high down to the low, and take a look at this. It almost lines up with the support and resistance levels. So I just drew a retracement from a major high to a major low. When you have retracements within that, you can see certain levels being hit. There's the 38% mark, which is 66.83. It doesn't follow perfectly. It's not like it's going to hit that, but it gets close. 78% mark, you can see that was definitely a support line. 691 where it was at before. It consolidated here for a couple of days. It almost hit there again, hit there, and now we broke out above that. So given that, you can extend it, and 1.61 is the golden ratio. And if you follow that, it puts us up to about the 71.54 mark, 715 if you're following SPY. That also lines up with where VIX has it priced in. So if this is a true breakout and we stay out above that, you can expect 715 to 720 or 7150 to 7200 if you're following SPX. Or if it falls back and retraces, you can see these different levels. And once you break below this 61% mark retracement, then you can expect a retracement back down to that 6500 mark. So Fibonacci is a good way to see where the levels are and where you can expect consolidation and further movement. It is not a prediction. You cannot buy stocks based on Fibonacci. It only helps identify where the levels are. Thought I'd show you that. Here is the screwworm.gov website. No real big news since December 18th. Here's the map again that shows where all the cases are happening. Got some that's really close to the Texas border. I expect that fly to make it its way into Texas. Flies don't care about borders. They are distributing about 100 million flies a week. And what they're doing is they're being very strategic. They're finding out where the cases are, and then they're dropping those flies over that. So they're being very strategic until they get up to 600 million flies a week. So it'll be a little bit more time before some of these facilities come online. But this one's supposed to come online early 2026, and that'll add another 200 to 300 million flies. And then you can expect to see cattle prices to fall. I don't expect the ports or the borders to open anytime soon because of this problem. They don't want to bring the fly in. But I did take a position because on the technical side, the cattle prices ran their course. They appear to be running out of steam. Didn't quite make it up to this resistance level. I'm not so sure that we won't hit that, but given the sell signal that my indicator prescribed, I went ahead and took a very small position. And if I do get any kind of retracement, I would expect it to land probably in this 230 mark. And then I'll make a determination whether I take profit or not, or let it ride down a little bit further. Technically, my target is around 222 a pound. Right now, we're sitting around 233 to 235 a pound. That was based on purely a technical position, not a fundamental borders reopening, tariffs, or anything like that. Now, speaking of tariffs, we were supposed to get a ruling on Friday that the Supreme Court will evaluate whether it was illegal for Trump to put on the tariffs. And if they do, then that'll be supportive of my position. But I am not betting on that. Strictly a technical play. All right. Earnings season kicks off this week. Excited about that. Several of the banks this week. So excited about some opportunities to play Volatility Crush around some of those earnings dates. I will look at those companies when we get to that point. But if you want to play put sales, which is selling puts on companies where implied volatility is high, you got to be out of these positions by the earnings date. So what we do is we take a position for this coming Friday and we play earnings for the following week. So what that looks like, these are the companies reporting earnings. There's quite a few, several banks, DHI. So I will be playing and have already started playing some of these positions. So there's Netflix on Tuesday, and then on Wednesday, you've got several more banks. These are all the earnings. So lots of opportunity coming up. I went out and scanned the universe of all those earnings that you've seen, and these are the ones where implied volatility is higher than normal. Last but not least, let's take a look at our economic calendar. Really nothing this week except inflation. We get CPI this week on Tuesday. That could be a driver. And we get PPI on Wednesday and retail sales. I expect retail sales to be strong because you have Christmas season and the consumer just keeps on spending. And then inflation, I expect it to be benign. We are expecting 2.7 on headline, 2.7 on core. This will probably be in line. I don't expect a whole lot higher than that. I think the inflation job is done. And in fact, probably even come in lower, and expect that to be the market mover for the week. This will come out, and then the next market mover would be PPI. But once CPI, PPI probably won't move it as much, but it can still move the market. With that, I hope you enjoyed this video. Please let me know in the comments, subscribe, and have a great week. Happy trading. See you next time.